Hi, this is Vijay Bambwani, and I'm back again to talk to you about Brexit and the victory of the Conservative Party in England with Boris Johnson at its lead. What does Brexit actually mean, and what does the victory of the Conservative Party entail for the Indian investor and the world at large? We'll basically take a rationalist view and see what it actually all means for you. I remember writing an article on equitymaster.com about what Brexit will typically trigger off. Now, the Conservative Party is basically aiming for anti immigrant jobs for the British population, and they are trying to protect what you can also call protecting their own turf. This typically means that globalization will be replaced by localization. There would be a contraction, some amount of contraction of the British economy as barriers are being brought up across borders. So, capital, manpower, ideas, goods, and services will have somewhat of higher tariff outgo before they can shift location. So, free trade is not what is happening here. Secondly, what it actually means is that it will trigger off some amount of disquiet or unrest in other countries as well. I remember in 2012, there was a lot of discontent in Germany because, being the largest economy in the European Union, the Germans were also the biggest contributors to the European Union's donation kitty. And the more people like Alexis Tsipras of Greece started asking for bailouts and bigger and bigger payouts to bail out the Greek economy, the more the German population cribbed, and justifiably so, that Germany should exit the European Union. So, is there a possibility of Brexit triggering to more calls of Grexit, which is German exit of the European Union? I think so. The French have basically made some passive noises about leaving the European Union if the British were to quit. Will they start also raising some amount of noise? Possibly so. Let us also not forget that the Scots don't really want to exit the European Union. So there is a possibility that there would be some amount of political turmoil within the United Kingdom because the Scots don't want Brexit, whereas England and Boris Johnson typically is pushing for Brexit. As financial investors, what it simply means for us is that England, as the global hub of financial markets, determines a whole lot of prices. So the London Interbank Offered Rate, or LIBOR, which is the benchmark rate for interest rates around the world, may not really be respected by everyone around in England. Similarly, the London Bullion Merchants Association determines gold and silver prices twice a day, which is called the AM fix and the PM fix. AM for the morning, PM for the evening. There is a possibility that fellow European Union countries may not adhere to the AM and PM fix as determined by the London Bullion Merchants Association. Similarly, the London Metals Exchange, or the LME, discloses industrial metal warehouse stocks every afternoon at 2 p.m. India Standard Time. Now, if at all the stock of industrial metals is rising, the price tends to fall on the MCX because there is a possibility of an oversupply. On the other hand, if the stock is falling, the prices of those base metals actually go up on the MCX. Typically, it does not only happen on the MCX but across the European countries' respective commodity markets as well. Hey, if at all England is leaving the European Union, this correlation might just break. So you could have temporary volatility and a mini chaos in the commodity market once this happens. But we are assured that the futures markets will be given up to 12 months to completely decouple from the European Union, which is Brexit will happen in the financial derivatives market with a lag. This is to avoid any kind of a sudden shock. But the fact remains that some amount of volatility and turmoil is likely to happen. What does it mean for you? As an Indian investor, what it simply means is that there will be amount of uncertainty and volatility, and the simplest step, as I've laid out in my earlier video, how to handle volatile markets, is to cut back on your leveraged exposure. Your long-term core portfolio of deliverable instruments that you have, either bonds, equities, or currencies, etc., can remain as it is. But your trading positions need to be curtailed and brought down in exposure footprint. I'm sure within 4 to 6 weeks time frame, maximum 8 weeks time frame, the shock of a Brexit will be taken in its stride and the markets will move on. I do not expect a major turmoil from this issue, but just to be careful out there, we can always tone down our exposure. This is Vijay Bambwani signing off for now, but not before I remind you, if you're watching this video on YouTube, please do not forget to click on the like button. Also, subscribe to my YouTube channel. Do not forget to share this video with your family and friends. And in the comment section, please let me know what you think about this video and what topic would you like me to cover in my forthcoming videos. Thank you.